Welcome to the weekly update, where I'll go over the action in the market for the week of April 7th through the 11th, and we'll see how things look for the week of April 14th through the 18th. It was a really wild week, and we've seen some improvements, but we're still looking negative overall. And I'll go through the charts and show you all of that. Before I get into the video, please know that I do updates every day and I provide commentary and analysis. I know my videos are longer, but if you really want to keep up with what's happening, and I look at a lot of different things, so feel free to check those out. I do post those on YouTube and Rumble. They're available right when the market closes for that particular day. If you want to get access to them earlier than when they're publicly available, please feel free to check out the program that I have, and it's still free for the time being. And there's a link right below this video that will take you to the website. And there's more videos that are posted there. There's newsletters that are available. There's courses that are going to be rolling out. Everything's free for right now, but that's going to change pretty soon. I do have a daily and weekly newsletter. In fact, I do a number of different videos, and I do a newsletter each day. I do one for every weekly video, and then I'm putting them all together into a weekly combo newsletter. I do have a PDF below every video that I post, so you can look at the slides and the charts, see if that helps you. I have the SPX investing program. Here's a link that will take you to that website. There's an active link right below this video. And then every day I update pivot points on the YouTube community tab. Those can be very useful for spotting intraday support and resistance, as well as support and resistance that lasts for the whole month. I also have a private Facebook group. You're welcome to join that. Just send a request. And then I really watch YouTube and Rumble comments. Most of the comments I get are within the program that I have. The other comments that I get, especially on Rumble, they're all garbage. And they're just social media people that are really trying to scam you, but they present themselves as some kind of an expert. I just delete those comments. But if you want to leave a legitimate comment, whether you agree, disagree with something that I said or a conclusion that I've reached, feel free to do that. And I do post both on YouTube and Rumble. Okay, so for the week, we were up 5.7%. Now, normally that would be a killer week, but compared to what we've been going through since the middle of February, this is just kind of a bounce. And we've been going down pretty ferociously. A lot of the tariff news, a lot of the back and forth between China. We've had interest rates that were up 0.5% from where they were just a week ago, and you've got a pretty nervous market. We were still above average with volume. What's interesting, though, is in Friday's session, we had an up day, and that was really the most positive day of the week. And we had Wednesday, but that was just crazy, out of control short covering that occurred during that day. But when we had more of a natural move up with the S&P, volume actually dropped off. It was still above average, but it really dropped off from what we saw earlier in the week. The technicals are still looking more negative, and I'll go through and I'll compare the weekly charts with what I'm seeing on the daily charts. Inflation for right now seems under control. We had CPI, PPI come out. Those were considered market friendly. The market's not really concerned about that. They're worried about inflation somewhere down the road. And as I mentioned before, we saw a big jump in the 10-year yield with interest rates really going back up. This is producing some growth concerns. There's these tariff tiffs that are going back and forth, and things seem to be changing all the time. Now we're getting into the beginning of earnings season. We had the banks reporting, some of the big banks, there'll be other banks that will report, kind of mixed results with that. And then that starts off earnings season. And so we'll just see if that has some kind of a catalyst for the market. Of course, for the last number of years now, been this debate. Are we going to go into a recession? Are we not? We just follow the data. Things are looking okay, but kind of leaning a little bit more over towards the possibility of a recession now than what it was looking like not so long ago. And we really didn't get much in the way of Fed speak. We had the minutes that were released, but it didn't say anything that the market didn't already know. And our trend is still negative. The green line is below the red line. Okay, so it was a crazy week. It was filled with both buying and selling at the panic level. And believe it, the buying was also at panic levels because there's a lot of people that actually short the market and they sell to get in. And when things go against them, they have to buy to get out. And that can produce what's called a short squeeze or a short cover rally. That's more what we saw on Wednesday. It really wasn't a lot of buying enthusiasm. It was buying because people are losing money and they have to get out. And the tariff headlines that we've been seeing, they cause the markets to be really confused. And we're seeing this all across different asset classes, stocks, bonds, gold, the dollar, even commodities to a degree. Stocks gained while bonds declined, and the dollar declined as gold advanced. Gold hit an all-time high on Friday. President Trump announced on Wednesday that he's pausing the reciprocal tariffs for most countries except China for 90 days. And so he's just going to do this baseline 10% tariff in the meantime while they can sit down and talk about things. Now, as for China, this is getting kind of intense now. President Trump raised the tariff on imported Chinese goods to 145%. China came back and said, well, we're going to raise our tariff to 125%. And plus, we're just going to ignore what you do from now on, which that could be exactly what Trump wants. Or it could be that China's trying to be on the offensive here and saying, we're just not going to give you any more respect in this whole regard. And so this kind of cancels things out as far as the tariffs between China and the US right now. But the concern that's coming over into the markets, and we really realized this from COVID, that a lot of the stuff that we need, we get from China. And when the COVID lockdowns happened, that really started to reduce the supply chains. And we get a lot of medication, we get computer chips, we get lots of things from China. And that's what Trump is trying to change and said, bring it back home. Let's make it in the US so that if a country gets angry at us and we're vulnerable to them because they make a lot of the things that we need, we want to stop that. Well, it's also affecting, okay, what are companies going to do with their business inventories? Are they going to have enough products? Are they going to let the products sit on the shelves? And this is producing a lot of concerns. Then Wednesday had just a really huge up day. It was exasperated by this short covering that I already explained. We had a 9.5% gain with the S&P, and the NASDAQ was up 12.2%. Those are massive moves. Then on Thursday, we gave a lot of back of those gains, and it looked like we were really going down, but we were finally able to stabilize and then bounce up off of the lows. Then there's other issues that are the market's dealing with. The dollar dropped down below 100. It's seeing a lot of weakness. You would think with all this tariff stuff, the dollar would be going up. That's what it did when they were talking about putting in the tariffs. And then treasuries, meaning interest rates. This is really producing some concerns in the market with as they apply to growth with the economy and with companies. Of course, $37 trillion, that produces some deficit concerns. And then is there waning confidence in US assets, stocks, bonds, the economy? It's been the world leader for a long time now. Are people starting to really doubt that that will continue? The dollar was down 3.1%, closed below 100. And the 10-year note, as I mentioned, it was up 0.5%. A week ago, we were at 3.99%. As of Friday, we closed at 4.49%, even with CPI and PPI coming out that were considered market friendly. All right, so the Dow was down, up 5%, the NASDAQ up 7.3%, the S&P up 5.7%, and even the small caps, which have just been getting hammered, they were up 1.8% on the week. Now, what they're trying to avoid is what might happen similar to what has happened before. We don't know if it's going to play out like this, but this is a chart from 1966 to 1982 of what CPI or inflation was doing during that time. And we're still kind of coming down where the black line is still going down a little bit here. What they're afraid of is that it's going to turn into what we saw back in the 70s, where we saw massive inflation. called it stagflation, where you had super high inflation with pretty much no economic growth, very difficult times. And that's what the market is afraid of. And a week ago, we were under this 4.02% level. Now we're back above it. And this is what RenMac has determined as being the line in the sand. When interest rates go above 4.02%, that's when it starts to eat in more to corporate profits. Now, this was not updated. We had this when the employment report came out that showed that there a little bit of an uptick after it had been declining with the long-term unemployed. Then Isabel Net says this isn't fun, but it happens. These are just corrections and bear markets that have happened since World War II. 25 of those saw a decline of 10 to 20%, and that's where the S&P is at right now. This is considered to be a correction. If we fall down over 20%, that's when it goes into a bear market. And then we see less of those, 7 and even less with a 30 to 40% decline. 40% or worse, we've had 3 of those. We don't know how things are going to play out from here, but usually the really bad times are more limited. But when they're bad, and it's not fun to go through that. The perma bears live for this stuff, and they're constantly predicting all this stuff, but it happens on a percentage basis not very often. Okay, what we need to do is figure out, okay, what kind of a drawdown do we have right now? This is the orange line compared to what we usually see. And yeah, we're going down. We're getting into the lower end here, but we've also been bouncing back up. So this just shows that we're not necessarily deviating all that much from other corrections than what we've seen. It's worse, and for some people, it's they've never seen anything quite this bad, at least so quickly. But we are trying to make a bounce back right now. And then we have to look at why is the Fed doing what they're doing. Now, if they come in and cut interest rates like they did last fall by 0.5%, that was just to kind of tweak the economy. At least that's what we were told, that inflation's fine, the economy's doing okay. We're just going to cut the rates and just kind of let the economy steam a little faster right now. Well, of course, you don't know if there was really some deeper meaning behind all of that. But that was the context, and that's how the market took it. So they saw cutting interest rates as a positive thing. Now, if the Fed comes in the next month or 2 months or the next couple of meetings and they cut interest rates because the economy is going down the tubes, that's a completely different context. And that tends to be more negative. So it depends on why are they raising or lowering rates. Is it because things are going good and maybe too good, or things are going bad and possibly too bad? Or is it just to kind of keep things humming along that are going pretty good right now? Then what about valuations? And I did go over this in the intermarket analysis video. This is the combined PE ratio looking at tech, media, and communications here, where you take all of that in the US and it's pretty high, but it has been coming down. When you take out those 3 areas, we have been declining with our overall PE ratio. We're still pretty high on a historical basis, but on a forward-looking basis, we've been able to drop below 20, and that's where we're going from being overvalued to being more fairly priced. Then for the 7th week now, individual investors have been below 50%, thinking that the market's going to go down. And that's pretty extreme, more than what we've seen in quite a while here. And then the top 10 companies looking at, okay, what are they? In the S&P, they make up 30% of the market cap, where in China, they make up 28%. And the US market's a lot bigger. It's been around longer. But China is making that good old try to have a big stock market like the US. And there are some days when volume actually exceeds in China what it does in New York, but still the US market is considered to be more mature. It's been around longer, and it's got a lot of the problems worked out, where they're still trying to work through those things in China. All right, FactSet, we're coming into earnings season, so we're going to be focusing more on this. This is actually out of date now because some of the big banks already reported, and this blog post was from the 7th of April. But it just says the financial sector's earnings. This is the preview, where they are seeing some weakness here in insurance. I mean, you've got the California fires, the North Carolina hurricane, But overall, we see consumer finance, capital markets, banks, they are decreasing here, but they're still positive as far as their earnings. But then looking out into the future, they actually see earnings going back up. Then we look at the S&P will likely report earnings of around 10%. Now that's lower than what had been happening before, but 10% is still pretty good. You can see right here for the first quarter, it's down from what it had been, but it's still quite respectable right now. And then looking out over a 5-year period, they have it coming down a bit, but it's a little bit below what the average has been. Okay, so here's the intraday chart going back to Monday, where just all kinds of choppiness all over the place here. Real battle between the bulls and the bears. And then we actually gapped higher on Tuesday and then spent the rest of the day coming down. Wednesday, this was the big update. This is when everything just kind of took off. Now, it these moves are actually percentage moves that are going on here. They're not just little choppy moves, but for the most part, we went sideways and then we started to break higher. Then later in the day, that's when things just took off and just raced to the upside. And that's when people that were short on the market, they're like, oh my gosh, I got to do something here. And they have to buy to get out. And that just kept pushing prices higher and higher. We gapped lower on Thursday and it looked like, okay, we're going to give those gains back. But then we finally found a bottom and we're able to bounce up from that. And then we were a little more subdued, at least early in Friday's session, and then we're able to kind of trail upward here. But you can see how these bars really got small. It's like a lot of people wanted to say, I'm done with this week. I want to get out of here. You know, floor traders and people that are really involved in the markets. It's like just get this week over with, get out of here, and I want to go and enjoy my weekend. All right, so for the week, and this is just the 5 trading days of the week, we did have all the indexes up. The NASDAQ 100 was up the most, followed by the NASDAQ, with small caps actually contributing to things. Now, this is just the 5 trading days, not Friday to Friday. Then, going back to the beginning of 2025, though, all of the indexes are negative. The NYSE had been holding up. Now that's negative, but we're under some pressure still, even with the up week that we just had. Looking at the sectors, we had tech, and this is good if it can continue. It was up the most. It was up almost 16% here. No, 16 points, which would be 8.75%. And then we have communication. That's another growth area. And then we want to see communication and discretionary doing better. And they did okay. The only sector that ended up being down was real estate. You get interest rates flying up the way they were this past week, and that spooks out the real estate sector. Then we look at this on a scooter score on a scale of 0 to 100. We still have staples looking the strongest. Financials are improving, but they still have some damage to repair there. They're in the 80s. And then we have utilities. That's more of a defensive area. And then the weaker areas, we have energy. That's just been getting hammered lately. And tech. We need tech to be doing better. Discretionary coming in at 42, not a great reading, but not as bad as it could be. So looking at the different sectors, just for the 5 trading days, we had tech and industrials positive. All of the other sectors were down. Year to date, we still have tech and discretionary underwater, with the other sectors performing better. And we see staples, utilities, and healthcare. These are more defensive, and they're the ones that are holding up better. We look at the relative rotation graph. We still see some improvements here, but these are more defensive areas. XLV, that's healthcare. XLP, those are staples. XLU, utilities, real estate, even though it got hit this week. And we see energy. These are more defensive type of areas. We're seeing a bit of a comeback here with the financials, and communications holding up okay. But then the growth areas, we see XLY, which is discretionary, XLK, which is tech. These are the areas that are lagging, and we need it to be kind of the reverse of what we're seeing here. This shows it more in spreadsheet form, showing a lot of these areas are improving that are in green, where we have tech and discretionary, they're red. And the areas that are showing some improvement would be industrials and materials. They're more cyclical, and they go more with the economy, if it's going good or bad. Then looking at the different indexes, we still have the S&P holding up fairly well because it's a mix of growth versus value. It's been under pressure because the value, excuse me, the growth part of the S&P has really been dragging it down, but the value part has been helping it hold up better than some of the other indexes. But you see the S&P 100, the OEX, and the NASDAQ 100, those are the areas that are showing some weakness. Utilities have been coming back up and showing some strength, but then we're seeing continued weakness with the mid caps, small caps, and the transports. Those are the weaker areas. Looking at this, where the S&P is looking pretty good. The composite Dow Jones, that's the Dow, the transports, and the utilities together. And then the utilities by themselves, they've been going sideways, but holding up pretty good. The large caps are what are getting hit, and that's where we see the yellow areas. Where we see the downright negative areas are the mid caps, the transports, and the small caps. Sentiment, well, we got up into double digits on Friday. We had been below 10 and we came in at 13 there. And we're still well below this 25 area. Usually we freak out when we get near or a little bit below 25. We've been camped under this area pretty much going back to February. We took a little peek out there for a while only to come back down. Active asset managers, a little bit of a tick up, but pretty much neutral right now in whether they're bullish or bearish. They came in at 56.96. The VIX came down from these high levels, but it's still really high. We're getting a reading over 37 right now. We get nervous when it goes above 20. And a little bit of an improvement here, but still looking more negative when we look at cash to the tech sector. And the Ridex bear bull ratio, these folks are just getting jacked around. We have an up day, they go long. We have a down day, they go short, or bearish when they go short, bullish when they go long. They're just kind of reacting to what already happened and then only to have the opposite happen the next day. Here's where the individual investors are continuing to give a negative reading. Now it says below 50 on the chart I showed earlier. On the chart that I have here, it means it's below 0. And we've been down here for 7 weeks now. The Ulcer Index, another fear gauge, is above the moving average. We're also getting a high reading on the daily side. Saw a little bit of an improvement on Friday with the spread between risky and not as risky bonds, but this has been coming down, and this is more of a sentiment gauge that I'm using. As this has been coming down, that's why bonds have been decreasing in price and increasing in yield. And we look at the VIX, showing that it's outperforming the 3-month average of the VIX. So that's just showing that shorter term fear has been really going up. We're not seeing much of a change with the equity put call ratio for 253 periods. That's still kind of leveling out here. As far as the economy, not seeing anything all that drastic with the weekly economic index that we get here. A little bit of a tick up, actually. And then the weekly chart that we look at of the Chicago national financial conditions, we're still under the black line. That's looking okay. Now, this is where things get a little crazy because the Atlanta Fed GDP Now forecast continues to be negative. But if you talk to the folks in New York, they're positive. Are they canceling each other out? I mean, does it mean we're really not having any growth here? And then here's the forecast from the Atlanta Fed showing a possible negative GDP. But if I charted the New York Fed on here, it would be positive. This hasn't been updated since last week, and we are declining here. That's more positive for the possibility of a recession. And this hasn't changed all that much either. The smooth US recession probabilities were below the black line. We get really nervous if we go above the red line. And then this is a quarterly report where we have actually been coming down. Other times when this goes up, that is often when we might go into a recession, but it didn't happen this time. Inflation, we're now into the second week, full week of the new quarter. And so with CPI and PPI coming out, we're seeing some adjustments here to inflation. As far as when the Fed meets on May 7th, there's a 60.2% chance that rates are going to be where they're at right now. And we're seeing a little bit of dropping off of that confidence. There's more people that are thinking, uh-oh, maybe something's going wrong with the economy. The Fed may have to come in and cut rates. And then we look at the June 18th meeting, about 50%-ish or so think that after that meeting, we will be 25 basis points or 1/4% lower than where we're at right now. and seeing a little bit more of a conviction there. But you also have some folks that think we'll be 0.5% lower, and other folks that think we'll be about the same as where we are right now. Then looking at the Fed balance sheet, it continues to decrease, which is what it should be doing, but it's still having a tendency to go up on a year-over-year basis. And not seeing anything all crazy here with the overnight reverse repurchase agreements. We spiked up a little bit, but now we're coming back down. This is suggesting that the short-term outlook for the banks were okay right now. Now, as far as looking at the weekly chart of the advanced decline line, we are still above the moving average based on price. We're coming down to the moving average based on volume. We've actually dropped below the moving average on the daily chart, so we're getting a mixed picture. We're positive based on price, negative based on volume but on the daily side, but here on the weekly side, it's holding up a little bit better. But last week, we saw this massive increase in new lows. And even though we had hardly any new lows this week, it's causing our 4-week and 10-week moving average to decline. And that's negative. That's showing internal weakness. Ticked up a little bit with our intermediate term. That's the red line, advanced decline ratio, and showing some improvement, but still negative with the short term advanced decline ratio. As far as our trend, here is the weekly chart. We are negative. The red line is on top. We're in a confirmed trend. It's above the moving average and going up. The Arun indicator is also negative. The red line, that's sellers. That's at the top. We see the green line, that's buyers. That's coming down. That's why we're getting the negative reading with the oscillator. And since it's below zero, it's negative. The mass index, we're watching the daily chart, and we're possibly seeing a second signal being generated on the daily side. We might actually get some kind of a signal here. If we keep going up, we're above the red dashed line. What we need to do is go above the blue line and then turn and come back down below the red dashed line. And whatever the market was doing that led to those signals, the mass index suggests that there will be a reversal of that. Then looking at the daily chart, we're getting concerned about this. We're seeing the 50-day moving average coming down very close to the 200-day moving average. Now, other indexes, the mid caps, the small caps, and the NASDAQ have already had a death cross. We're getting really close to one here with the S&P. The Dow is also kind of close. And the NASDAQ 100 is very close. But we're positive here. We're positive on the daily side, and here on the weekly chart, we're bouncing back up, but we're still below the moving average with the boom indicator. We're trying to cross back above the red line, which would keep this indicator positive. This is smart money indicator number 1. Here's smart money indicator number 2. It's negative. The histogram bounced up a little bit here, but we follow the red line, and that's declining, so that's negative. But we're showing some improvement, but we're still below the moving average here with the Chaikin oscillator. This is smart money indicator number 3. So it's improving, and it dropped below this pink line, but it hasn't turned positive, at least yet. The vortex is negative. The red line is above the green line. And this is positive, actually. We fell down below this S1 support level. We were able to get back above that. Now, if we could get back up to this pivot point, the P right here, that would be even more positive. And we are still holding out above the midpoint of this trend channel going back to 2009. But we've dropped below the 50-week moving average. And so that is negative. But the red line's still going up. The longer we stay below this, the more that red line's going to start to roll over. This is the longer term trend. We still have some ways to go here, but if that blue line crosses below the red line, that's going to be a death cross on a weekly chart, and that's a long-term trend. And we're improving, but still below zero with the McClellan oscillator, but we're below zero and declining with the summation index based on price and volume. That's negative. We're below zero and declining based on price and volume with the Swindle trading oscillator. We're improving here. We've actually turned over positive on the daily side with the bullish percent index. I don't have the moving averages on here. I do have them on the daily side, and that's actually crossed back above its moving average. So we had just a really low reading here, and we're trying to bounce up from that reading. And we're negative here with the momentum. We've been going down, almost straight down here with the PMO, the price momentum oscillator. We're below zero based on price and volume. We saw a bit of an improvement after being extreme negative with the PMOs inside the S&P that are rising. We're still extreme negative with the buy signals inside the S&P, and we're declining with the PMOs that are above zero. We did get an extreme negative reading both on the daily chart and on the weekly chart here with the percent B indicator. That has been worked off enough so that we're no longer extreme. But momentum is down in the short, intermediate, and long term with all of our oscillators. And another oscillator is the Copic curve. That's negative. The force index improved, but that's still negative. We're below 50 and declining with the money flow. And then we had a massive up week. So after having a massive down week that was extreme, now we had a massive up week that was extreme. But going back over the last 50 weeks, we're still above the midpoint and we're trying to bounce from that level. That's hanging on for the time being. Longer term support is still holding. We're just busting through all kinds of shorter term support. Okay, the Stochc RSI no longer extreme and starting to bounce up. We're actually extreme positive on the daily side. Then we look at the Williams percent R, which is no longer extreme negative. That's showing some improvement. The RSI, after being extreme negative, is trying to bounce up. And we're bouncing up. It's still below 50 with the ultimate oscillator. And we're rolling over, but we're still positive here with the special K weekly chart. We're still negative on the daily side. This is encouraging, and this is long-term support. These are Fibonacci levels going from the October 2022 low to the February 2025 high. We hit right at that 50% point and bounced back up, and we were able to recapture this 38.2% retracement level. This is long-term support, and it's quite positive. Now, with the shorter-term moving averages, the 10-week and the 40-week, we're already crossing over negative. But what I wanted to point out here is that look how we came right down to that point, and then we're able to bounce up off of that. So the market looks at these things. As far as the charts on a trending basis, we are negative with the Heikin Ashi. We're negative and pointing down with the Kigi chart. We're negative with the Renko chart, and we're still negative with the three-line break. We're negative and declining with the ease of movement. And we had more O's drawn in here on the point and figure weekly chart. That's not looking so good. Even though we closed well up off of that, it caught up onto those lows that was set earlier in the week. Momentum is still declining here in the long term. We're negative in the intermediate term and actually improving, but still negative in the short term. We've gone from negative to neutral with the Elder's Impulse system for the S&P weekly chart, but we're still negative with the Parabolic SAR weekly chart. We're negative on the daily side as well. Some broad market measures, we're still negative in the short and intermediate term with all the different stock indexes, where mid caps and small caps are even negative in the long term. And we're negative across the board with stocks, bonds, commodities, and the dollar. The dollar is negative across the board. Commodities are taking a hit into the intermediate term, where bonds are positive in the intermediate term, but negative in the long term. Kind of crazy right now. And this just looks at the different indexes, showing how we were able to come well up off of the lows with the S&P. We did bounce with the mid caps, showing more weakness here with the small caps. The Dow still hanging on to a long-term trend, but below its 50-week moving average. The NASDAQ still below its 50-week moving average, hanging on, where we've actually turned negative on the daily side. We're really close to turning negative with the NASDAQ 100, but we're not quite there with the weekly chart here. Mid caps, we're negative, both on the daily side and here on the weekly side. The NYC has been holding up better, but it's well below its 50-week moving average. Small caps, negative on the daily side, negative here on the weekly side. The Wilshire, this is a daily chart, starting to cross over negative. That's a broad market measure. The FANG index, weekly chart, also showing some weakness, still below its 50-week moving average. All stocks, which means stocks in the US and around the world, still below its 50-week moving average, but it did bounce up 4.81% this week. ARC, underneath both of its moving averages, it was up 9.42%. And the banks bouncing back a little bit. That's encouraging, coming off of an extreme reading with the RSI, but the momentum as measured by the MACD is still negative. April is supposed to be good. We're up over the last 5 years, 40% of the time, but we have a negative return. Then looking at just traditional Dow theory, showing how the Dow has been coming down but bouncing up, where we're seeing more weakness here with the transports. and we're pretty much going sideways with the utilities. Then the broad market, this looks at commodities, and they are still in an uptrend, even though they got hit recently. Oil is continuing to drop. We're into the low 60s now. That's not necessarily inflationary. The dollar, we're seeing a longer term downtrend now, and we drop below 100. Gold setting an all-time high this past week. Silver is in an uptrend, but still has a ways to go to get back to its all-time high. Copper, this is still in an uptrend, and I have this here in the weekly newsletter that I have. Any chart that has writing like this on it, I include that in the weekly newsletter. It says copper is often used as an economic barometer looking forward. If the copper market was concerned about economic growth, we would be in a downtrend, not in an uptrend. Even though it got hit, it did bounce back. Then we did get hit with the total bond ETF. We came down to the 200-day moving average, and we're trying to bounce up off of that. And the stock to bond monthly chart is still showing that we're below this moving average. That's long term. Here's a daily chart of the yields, how they have been coming down, and then they just really went back up this past week. And then looking at international rates, they tended to come down. If you're in Germany or in Japan, they bounce back up a little bit here. Then looking at the intermarket analysis chart, where we have gold performing the best in 2025, bonds are back to break even based on price. The dollar is the least negative. Stocks are not in last place anymore. Now oil is. It's been going down the most. The NASDAQ 100, which is growth, to S&P, which is growth and value ratio, is still weakening, and we're about ready to see a death cross with this ratio. The S&P 100 is still in an uptrend compared to the rest of the S&P. Those are the biggest stocks that make up the S&P 100. It did bounce up this past week, though. Growth to value, we need growth to be outperforming value. It's been really underperforming, but the longer term trend is still positive. Gold has been really outperforming. It's been going up as stocks have been going down. That's why we're seeing this ratio shooting up. Bonds are starting to outperform stocks. And on the daily side, we've seen a golden cross with this ratio. We're not quite there yet with the weekly chart. And gold has been going up as the dollar's been going down. So this ratio has just been shooting up like crazy. Discretionary still in an uptrend, but really showing some weakness when compared to staples. Low volatility, toilet paper, toothpaste, really starting to outperform on a longer term basis. And we've seen a recent golden cross with this ratio. Energy could be starting to outperform tech, but it really pulled back this week. We'll have to see if that's going to continue to fall or continue to go back up. And then small caps have been getting hammered. Tech has been getting hammered. So we're going sideways with this ratio. Longer term, we don't really see anything other than more negative signs here on the NYSE breadth thrust. But when we look at this WAG NYSE breadth thrust, we had an extreme reading below this blue level. Within 10 days, can we get back up to this red line? That's very positive if that ends up happening. So I'll be watching for that. Then longer term, we're back up to this trend line going back to the 1987 crash for the S&P. This further blows up that same trend line. We're right back up to the trend line itself. We're still giving a full-on Zohorchak buy signal, even with the weakness that we've been seeing. This isn't as touchy as it usually is. For some reason, it's not picking up some negative things. But we're still below this trend line going back to 2009 with the weekly chart of the NASDAQ 100. Dropping below zero, showing internal weakness over a 50-period moving average of the new highs, new lows for the S&P. Also below zero and declining with the NYSE new highs and new lows below the midpoint with the 50-period moving average. We're still holding up here, though. NASDAQ 100, that's growth. Dow considered value, even though NVIDIA's in there and Microsoft and so forth. But we're not breaking down too much yet with this ratio. And then we look at the NASDAQ 100 to the small caps. And it's not that the NASDAQ 100 or the QQQs are doing good. It's because small caps are falling apart. And so that's why this ratio continues to go up. Pretty much going sideways with the 3-month yield. Not really seeing any warning signs there. We still continue to decrease with the new highs, new lows on a cumulative basis for the NASDAQ. Seasonality. We're supposed to be happy now, where we're up 73% of the time with a return of 1.6%. Well, we're not even halfway through the month yet. We'll see how that goes. And then November through April is the most positive time for stocks, where we're up 77% of the time with a return on the average of 7.1%. And then April and the first half of April and the second half of April are typically better performing times of the year. And then when you look at April, whether you go back to 1950, the last 20 years, the past 10 years, or during a post-election year, that's supposed to be positive. It's got some work to do if we're going to keep that statistic alive there. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.